Hi, my name is Alec Overby. I'm a senior analyst here at Cohen & Steers, and I'm going to be speaking to you about the office market. I'm going to talk to you about three topics: the current state of the office market, our medium and longer term outlook on the office market, and where we see valuation and opportunities. So let's start with what's the current state of the market. Leasing velocity in general was significantly depressed during the pandemic as office utilization rates essentially plummeted to nothing because we all started working from home. Office leasing velocity has recovered, but is still, call it 30% below pre-pandemic levels, mostly on the coast, where the Sun Belt, we've seen office leasing velocity return back to pre-pandemic levels. As a result, office vacancy rates during this pandemic spiked dramatically, more so on the coast, again, relative to the Sun Belt. And this is translating into a net effective rent decline of in the 10 to 15% rate nationally. Obviously, again, lower net effective rent declines in the Sun Belt in the 5 to 10% range, and higher on the coast in the 20% plus range. So that's kind of where we stand today. What's the outlook? So the outlook over the next 5 years, including the two pandemic years that we're going through, 20 and 21, is not necessarily a very bullish outlook. And it's really determined by four main factors: the work from home impact, the de-densification or more need for square foot per employee, and then your traditional metrics of the amount of construction that's delivering, as well as just office using job growth. So let's talk about the most controversial, which is the work from home impact. Generally speaking, whether it's through survey data, third-party experts, third-party brokers, as well as interviewing major office tenants, it's how much of the full-time work from home population is going to eat into that office using job growth. And the way we measure that is, what's the percentage of office using job growth that's going full-time work from home? Pre-pandemic, that was around 5%, and we think leaving the pandemic, it'll grow to 15%. So that's about a 10% headwind to demand over the next several years. And again, this will get phased in over time. It doesn't happen all at once. Then the offsetting factor is de-densification, or the need for more square feet per employee. This is a healthcare crisis. We think that people are going to need to be spaced out a little bit more. There's going to be more amenity and meeting room space to accommodate more light, more air, better healthcare feeling. And this will offset that 10% decline by, roughly speaking, 3 to 5%. So overall impact from COVID long term, we think is in that 5 to 7% range. Now going to the traditional metrics. On the supply side, there was a lot of supply going into the pandemic. A little over 3% of stock was yet to deliver. And the other thing that we've seen is, in order to attract talent into the office, it's really pushed this demand for new, which is actually having supply start up a little bit sooner in the cycle than we would normally think would be the case given elevated levels of vacancy. So as a result, we think supply growth is going to be in this, call it 5 to 6% range over the course of 20 through 24. And then finally, we have office using job growth. This is kind of the most interesting thing from the perspective of we're really seeing change on the forefront, what's really accelerating trends that we saw before. And the trend that I'm talking about is the move or migration to the Sun Belt. We've already seen to date that office using jobs is above pre-pandemic levels in the Sun Belt, but in the coast, it's office using job growth is probably still 3% below pre-pandemic levels. That's a 300 basis point spread over a year and a half. And we think that that type of spread in terms of growth is going to be maintained. And as a result, you're going to see really outsized job growth in the Sun Belt and less job growth on the coast relative to history. So this all adds up to a net demand impact of negative 5% on the whole, with the Sun Belt being roughly flat and the coast being down 6 to 7%. And that kind of is a pretty bearish outlook when you think about over a 5-year time period, net demand is going to be negative. That's very rare to see in commercial real estate assets in general. So now let's talk about valuation given that backdrop and where their potential opportunities could exist. So from a valuation perspective, the coastal office REITs are trading in the low 6s implied cap rate. We think market cap rates are in the high 5s. And as a result, we think the discount to NAV is somewhere in that 5 to 10% range. On the Sun Belt side, it's actually a pretty similar story. Implied cap rates are in the mid 6s. We think that market cap rates are right around a 6. Therefore, they're also trading at around a 5 to 10% discount. So okay attractiveness on NAV. As we move to cash flow multiples, office is a very inefficient sector when it comes to converting rent to cash flow. And you see this in their cash flow multiples. So the CBD office REITs are trading in the high 20s, and REITs are in the mid 20s. And the CBD office REITs are going to have very low single digit kind of cash flow per share growth, whereas REITs in general will be in the mid to high single digit growth range. So it doesn't screen particularly attractive on multiple. When we shift to the Sun Belt, the Sun Belt is trading in the low 20s, again, versus REITs in the mid 20s, with a cash flow per share outlook growth rate of around 5%. So it screens significantly more attractive to office and marginally attractive relative to REITs. So where are the opportunities? Clearly, we think within office, the opportunities are in the Sun Belt. But one thing that I kind of mentioned before that I'd like to expand on a little bit is this demand for new. So younger portfolios that are tethered towards new development, we think will significantly outperform older portfolios. And the reason for this is this was a healthcare crisis. The demand to get employees into their office space, the employees aren't going to feel the need to really want to do that unless their space is cool, their space is amenitized, and they feel healthy in it. And really only new product or recently developed product can really accommodate that, especially on the coast where the average age of the office stock is very old. Well, that's all I have for today. I look forward to updating you in the future.